Okay, Assalamualaikum and very good morning, everyone. So for today, we are going to continue with the second topic. Bear with me 1 second. Okay, so the second topic is about quantitative techniques in investment. Okay, so we have a few models or a few techniques or a few uh, steps in terms of how we can do some analysis with regards to our investment decisions and how to choose or how to make decisions with regards to our investment. Give me 1 second. I want to take my calculator. Okay, so there are a few here subtopics. We have how to compute the investment return based on historical data, based on expected returns, how to measure risks. Okay, the first two is basically returns, measurement of returns. And then 2.3 is the measurement of risk, specifically for the usage of standard deviation and also variance. And then the application of bell curve in investment decision. And finally, the computation techniques relating to investment criteria. Okay, here we will use what we call the concepts of capital budgeting, I can say, whereby we use three techniques, which is the payback period, net present value, and also internal rate of return. Okay, I guess some of the techniques that I'm talking about just now, you've learned it before, perhaps in financial management. Okay, or else we are going to have some refresher here. Okay. Okay, as the introduction. Okay, financial planners will inevitably come across investment that already committed by their clients. So we need to analyze, or we need to recheck, okay, the current positions, and we want to know whether the existing investment, okay, are generating enough or sufficient returns or not. Okay, this is if you already have clients who have already invested before. But sometimes you may find that your clients or even yourself don't invest in any investment just yet. Okay, regardless whether it's a new client with no investments, or it can be clients with existing investments. Doesn't matter. But anyhow, we want to measure if they have invested before, whether their investments are generating enough returns or not. And as comparison, we're going to compare it against relevant benchmarks. And we want to see as well how much risk they are exposed to with their current set of investments. Okay, and we can prepare an alternative solution with regards to investment proposals. Okay, so here we want to measure the historical return on investment, okay, based on historical rate of return. And as I guess I've already discussed in our previous week, when we talk about return on investment, it can come in two forms. Okay, number one is the capital gain. Okay, the capital gain. This is basically can come in the form of price appreciation. Okay, meaning there's an increment of values or price of your investment. So meaning if you purchase your investment, say at 100,000, now it becomes 120,000, for example. So the 20,000 is the capital gain. There's an increment of values of your investment. So that's one form of return. And the other one, all right, is in the form of income return. Okay, ataupun cash flows. So how to measure this kind of returns? We can use this simple formula. AR ni annual return. Okay, the measurement of annual return is the difference of the value of your investment. Okay, meaning the current minus the original value. Okay, plus any income return. Why is the income return? So income usually can come in a form of interest, can be in a form of dividend, for example. Okay, so any return in terms of dividend or interest throughout the period, the same period, okay, we add together with the difference of your value of investment. And we divide it with the original value. Okay, we divide it with the original value of your investment. So for example, okay, Alex bought 1,000 shares in company A at the beginning of the year at 11 ringgit per share. So this is the price per share, 11 ringgit at the beginning. So this is your V0, the value of the original investment. And during the year, he received net dividend of 30 cents per share. So this is the income, or Y. Okay, and the price of the share at the end of the year was 12.50. So this is the value of the end of the year. So the question asks to calculate the annual return of his investment. So recall the formula is AR, the difference between value of your investment plus the return, and we divide it with the original value. Okay. In terms of the value of your investment, obviously this is just a price per share. So in order to get the whole value, you have to multiply it with the number of shares Alex bought, which is 1,000 units. Okay, so therefore, in order to find V1, for example, simply take 11 ringgit. Sorry, this is V0. V0 is 11 ringgit. And then we multiply with 1,000 units. So it will be 11,000 ringgit. And the value of the investment at the end of the year would be it's 12.50. 12.50 cents, which is the price at the end of the year, multiply with the units. So it will be 12,500 ringgit. That is the total values of the investment. So if you translate this into our equation, it would be 12,500 minus 11,000. Okay, but don't forget the return. The return is 30 cents per share. So to get the Y, it's 30 cents. All right, multiply with 1,000 units. So it's 300 ringgit. So you add with 300 ringgit here and divide with the original of 11,000. So if you have your calculator, okay, so far we don't use the financial calculator yet, but towards the end, we have to use financial calculators. 11,000 plus 300, right, 11,000. So it equates to 16.36%. Okay, 16.36%. And that is the annual return of the investment for Alex. Okay, so that's how we measure the annual return for the investment. Okay, so again, if you have the type of investment that don't give income dividend ataupun income returns, so meaning there will be no dividend or interest, for example. So to find the annual return, simply again differentiate the value of your investment. And obviously, when you add with the income, you will add with zero lah. For example, if you invest in gold, for example, right? Obviously, there will be no income returns. Okay, so you can calculate your annual return simply by having the current value minus the original value divided by the original value. Okay, and you will get the annual rate of return. Okay, so this is the basic idea of returns based on historical prices ataupun historical return. Okay. So this is another example with zero dividend. Okay, zero dividend. So at the beginning of the year, Ben purchased 20,000 units, okay, of Cuberhard at 2 ringgit per share. Okay, so this is the original value. And the price dropped to 192 at the end. So again, calculate the annual return of his investment, okay, for Ben. So similar concept, you can calculate the value of the investment by having the units multiply with the original price. So here it's 40,000. And the value of the investment at the end of the year now dropped to 1 ringgit and 92 cents. So if you grab your calculator, and you get 38,400. Okay, why for this case is zero? Because zero dividend, zero dividend. So therefore, to find the annual return, take 38,400 minus 40,000, and we divide with 40,000. Okay, so in this case, as you can see, the price drop, right? Okay, the price drop. So therefore, you will have a negative returns. Okay, you're gonna have a negative return. So you divide 40,000. So you're gonna have a negative 4%. Okay, negative 4% return. So in this case, so if you see this situation, okay, you don't switch the position to make it positive. No, it's always V1 minus V0. Okay, V1 minus V0 and divide with V0 as well. Okay, the original value of the investment. So in this case, as I mentioned, if it's dropped, we know already our annual return will be a negative return. And this is proven with our calculation. Our return here equivalent to negative 4%. Okay, negative 4%. Okay, so very simple. As a beginning of our lecture, how to measure the historical rate of return. Okay, ataupun the annual return based on historical performance of our investment. And let's say if you have multiple returns for several years, okay, how to measure the average of your returns? Okay, so here we have two different measurement of average or mean. The first one is called arithmetic mean. Okay, arithmetic mean usually or simply known as simple average. Okay, arithmetic mean is actually simple average. Okay, the normal way we measure average in our daily life, if you want to measure average lah. So what you need to do is basically, if you have like this 4 years of information, what you need to do, you add all 4 years and we divide by the number of years, which is in this case 4 lah. Okay, so the annual return is given here. Okay, and again, if you want to measure the annual return, use the previous formula whereby you take ending minus beginning divided by beginning. Okay, meaning 70 minus 100,000 divided by 100,000, then you get the annual return. So whenever the ending values is lower than the beginning, like year 1 and year 3, for example, we know that our return would be negative. Okay, the return is negative whenever our ending value is less or lower than the beginning value. So it shows that the price dropped. Okay. So to find the average or the arithmetic mean, simply add all 4 years, because the formula is the sum of the annual returns. So you add all 4 years returns. So negative 30 plus 100 plus negative 50 plus 42.86. So we get a total of 62.86%. So this is the numerator part of our formula, whereby we add all 4 years returns. And in order to get the mean or the average, you have to divide this by 4, because our number of years is 4 years. So if you take that 62.86 divided by 4, so it will give us of 15.72%. Okay, so this is average or the arithmetic mean of our returns. Okay, this is the arithmetic mean. However, obviously there will be some cons or some disadvantage if you use simply arithmetic mean, because the results or the answer might be misleading. Okay, because if you can see the range here, we can get as high as 100% and as low as negative 50%. So if we just look at the average return of 15%, so our decision making might be misleading. Okay, it shows that this investment is good, for example. However, if we look closer based on the range of the return, this is actually a very high risk kind of investment because of the fluctuations of the return. In fact, from 1 year to another, okay, from negative and then increase to high 100%, and then they drop very drastically to negative 50, and then the following year increase back. So we can say that this kind of investment is actually risky, even though the average return, if we just look at the average return, this is actually a decent return. So therefore, we cannot rely just by looking at the arithmetic mean. So the alternative average that we can use is by looking at the geometric mean. Okay, the geometric mean. So the formula for geometric mean is the product of all returns. Okay, when we say product, it means the multiplication. Multiplication of your annual returns. Okay, multiplication of annual returns. So again, if you have 4 years of returns, just like the previous example, you multiply everything, and then you add 1. You add 1 here. Okay, it's actually, sorry, you have to multiplication of ARs, but these ARs you have to plus with 1. Why we plus with 1? Because all of our returns here is in, kalau kita convert in percentage, this would be negative 0.3, not percentage, to convert into point form, sorry. So this one is 1, this one is negative 0.5, and this is 0.4286. So sorry, there's no negative here. Okay, so in order to use geometric mean, we have to add 1 with all 4s. So meaning, it would be 0.3 ni, if you add 1, it will be so example year 1, it will be 1.3. When you add 1, so meaning R plus 1. For year 2, it will be 2. Okay, 1 plus 1 is 2. This plus 1 is year 3. negative 1.5. And for year 4, it's 1.4286. Okay, so this is our R plus 1. So to solve our brackets here, simply multiply all of this. So meaning to find geometric mean, it will be negative 1.3. Yeah, put a bigger bracket here, times 2 times negative 1.5 times 1.4286. Okay, then to the power of 1, our n is 4 years, so divide by 4. Then we minus 1 at the back. Okay, so 1.3 times 2 times negative 1.5 times 1.4286. Okay, to the power of 1 divided by 4 minus 1. Okay, so here the average indicates 53.6. Okay, let me double check the answer. 1.3. Sekejap Okay, negative 1.3 times 2 times negative 1.5 times 1.486. In 0.5364. Okay, give me 1 second. Right, so in this case, if you convert it into percentage, okay, so here even higher, times 100. So it's 53.64%. Okay, 53.64% based on the geometric mean. Anyway, so that's how we measure. So now, within 5 minutes, okay, within 5 minutes, can you calculate for me the arithmetic and also the geometric mean of the returns of stock A below? Okay, I'll give you 5 minutes. Can you try? calculate the arithmetic and also the geometric means of the stock. Okay, anybody? What would be the arithmetic mean? And what would be the geometric mean? Okay, based on ni tadi, I noticed that when I see the answer, I guess something wrong with it. So let me delete this thing. Give me 1 second. It's supposed to be we cannot add just simply like 1.3 add 1 jadi 1.3 yeah. It's supposed to be 1. Sorry, second. It's supposed to be 1 plus it's -3. So meaning it's 1 minus 0.3. So it's supposed to be 0.7 here. Okay, 0.7. So 1.1, yes, correct. 2, here also the same. It's supposed to be 1 minus 0.5, which is 0.5. Okay, so we have to change it here. And it's supposed to be 0.7 here. So if you recalculate this, 0.7 times 2 times 0.5 times 1.4286 to the power of 1 by 4 times 1. So you get 0% here. Okay, based on the geometric mean, based on the geometric mean, it's 0%. Based on our arithmetic mean, it's 15.7%. So that's why it doesn't mean a lot when we measures. Yes, especially if we have this kind of variation. But anyway, going back to this one, what would be the arithmetic mean and also the geometric mean? Okay, and for this case, it's no issues because all are positive values. So anybody quickly? Okay, so the Laka had here said it's 5.45 for arithmetic mean. Okay, correct. For arithmetic mean, it's 5.45. And for geometric mean, so based on my calculation, okay, for M is straightforward line. It's basically it's 5.3 plus 4.6 plus 3.6 plus 8.3. And you divide it by 4. So you get 5.45 just now. Okay. And for the geometric mean, it will be 1.053 times 1.046 times 1.036 times 1.083. Okay, and then you power it to 1 divided by 4, then you minus 1 at the end. So here I get 5.4, I can say 5.44 convert it into percentage. Okay, this is what the 5.435. Okay, so thank you, Zulaika, for trying. So that's how we measure the arithmetic and also the geometric mean. All right, let's move on with the next one. After we measure the returns, okay, based on the historical events ataupun the historical rates, you might have to measure risk as well. Okay, the risk of investment is basically defined as the variation of your expectation of returns versus the actual returns that you might have. Okay, so the differences or the variations of your expected return versus the actual return that you will receive in the future, that is the risk that you have to take. Okay, so in investment, investors are assumed to be rational in making decision. Okay, obviously, even though every individuals will have different pick ataupun different take on risk. Okay, some might be risk takers, some might be risk averse, or some might be risk indifferent. Okay, depending on individuals. So for those yang willing to take risks in order to get higher returns, they are assumed as risk takers investors. Okay, and those yang try to avoid any types of risks, and without jeopardizing the capital, those are considered as risk averse. So before an investment is made, there should be an expectation of the return. Obviously, we will set some expectations or some goals that you want to achieve, and the deviation or the variation of such from that returns is called it is called as return as risk. Sorry. So expected return can be developed. Okay, and this is one of the common method in order to, again, to measure the average of the past returns. Okay, using the risk factor as part of our measurement. Okay, So expected return is another words for the average return, okay, based on our measurement. So in terms of the computation of risk, we have three separate calculations here. Number one is the variance. Okay, the variance, or this is supposed to be squared, sigma squared sepatutnya. Okay, variance, whereby the formula is the sum of the annual returns minus with the expected or the average return squared, divide by the number of years. And in order to get the standard deviation, we square root. Okay, we square root our variance. Okay, so as D measures the dispersion of returns from the mean. So meaning if we draw a line, for example, and this line indicates the years that you have. So if the point of your return is away from the mean, from the average. So imagine this line is the average. So if we plot, and you can see that the rate of return disperses or varies from the mean quite, far from the mean. This indicates that the standard deviation will be high, okay, and therefore your risk is considered to be high as well. Okay, so the larger the dispersion like this, there'll be the smaller the chance for you to achieve your expected return. Okay, that's why we call them as a high risk investment. But alternatively, if you have another types of investment, for example, that disperse very small and close to the average, okay, throughout the time. So if you plot, it will be very minimal fluctuations, for example, like this. This is what we call as a lower dispersion. And when we talk lower dispersion, it indicates lower risk kind of investment, because we know that the average or the expected returns will be, within plus minus of lower margins. So meaning chances to get your expected return to be high because it fluctuates around the mean. So not much different as compared to this one, because the difference is extreme, right? So therefore, if you have these extreme differences, obviously indicates higher returns. So in investment, obviously, we will try to find this kind of returns so that we can manage our expectations, right? And in order to measure these movements, we use standard deviation. Okay, and the third measurement, we can use coefficient of variation simply by using standard deviation divided by the expected returns. Okay, so this is just another measurement of risk. Okay, so the higher the CV, similarly, the riskier is our investment. Okay, so let's assume that this is a unit trust investment, okay, and give us these returns. Year 1, 5%, year 2, -1, year 3, 15%, year 4, 6%, and year 5 is 21%, with the average of 9.2%. Okay, you add all 5, divide by 5, we get the average of 9.2. So the average here, 9.2, are referring to the expected return, the ER. Okay, the expected return is actually the average. So here is 9.2. Here 9.2. So the same, right? So this is how it measures. Okay, this is how we measure. Number one, the variance, and then the standard deviation. Okay, if you recall the formula just now, it's the sum of, the difference of each returns minus with the average return squared. Okay, and then we divide by 4. So meaning, for year number 1, the return is 5%. So 5 minus 9.2. Okay, and you get these differences or deviation, negative 4.2. Okay, negative 4.2. And we do similarly for all 5 years. Okay. So the deviation is basically the difference between return minus ataupun the annual return minus the expected return. Okay, so this bracket deviation is simply the difference between these two. Okay, and you recall, in order to get the variance, we need to square. For this part, we have to square deviation square. So if you take your calculator and you put negative 4.2, then you square it. Okay, so all the negative ones, all the negative values will be removed. Okay, when we square of a negative numbers, our variance will be positive. Okay, will be positive. So when you sum all 5 years of variance, so you get 304.8 and 304.8 when you divide by 5, because we have 5 years. So here our variance is equivalent to 60.96. Okay, so if you get 304.8 and you divide by 5, because we have 5 years of period, and this will give us variance of 60.96. Okay, so I recap. In order to get the variance, first, find the difference between your returns and the average returns for all 5 years. Okay, and then you square each and every one of them, and then you sum all of it. Okay, up until the sum of all variance, you are actually here. Okay, you are actually this part, sum of annual return minus expected return squared. This is the first part, you're getting 304.8. And then you divide by 5 because we have n of 5. Then we get the variance of 60.96. All right, and in order to get the standard deviation, simply square root 60.96. Okay, if you square root 60 or 0.96, then you get 7.81. Okay, 7.81. That's how we measure standard deviation. Right, so if we have just one returns, obviously, we cannot say whether it is really high or not. But based on, based on the figures that we have here, we can say this is considered high risk kind of investment. Okay, because it fluctuates quite high, right? Fluctuates quite high. If the average is 9.2, so meaning if the average is 9.2 here, okay, you can see it goes as high as 21, okay, and as low as -1 down here. So if you plot your investment, let's say this is year 1, year 2, year 3, year 4, and year 5. So you can see that, okay, it starts here in year 1 because it's 5% is below 9.2, and then they drop here, and then year 3 they goes up here, then drop to 6, and then goes up back to 21. This is how it looks like if you plot it in graph. And by looking at this, we know already this is high risk investment, and it's proven with a high standard deviation. And for the third one, if you want to calculate the coefficient of variation, this one, you take the standard deviation divided by the ER. So our standard deviation is 7.81, and our average return is 9.2. So you get 8.85. Okay, so this is just an alternative calculation. Okay, if they ask you to find CV lah, coefficient of variation, but most of the time, usually they will ask you for variance and standard deviation. These two will be the prominently used measurement when we talk about measurement of risk. So we have so far computed standard deviation based on the historical returns, just like example number 3 just now. Here we go, number 3. And in Malaysia, unit trust companies are required to present the past 5-year returns in their prospectus, and they are promoting. Okay, as you all know, prospectus is a document as a brochure whereby you have to, as an investment company, you have to provide this information for your potential client. So potential client must have this information before they make decisions. Okay, so you as investor or as a financial planner in the future, you can take this information and do your own analysis, whether this kind of investment considered high risk with a suitable returns or not. And similarly, life insurance also required to present their 5 years performance as part of their quotations, especially if they sell insurance or takaful, which are considered investment link, right? Investment link fund, because whenever there's investment involved, obviously, investment companies or even life insurance companies must provide enough information for your potential clients before they make decisions. Okay. Right. This is another set of questions whereby instead of giving historical returns, okay, there are some positions whereby we don't have that information, okay, right? In situation whereby there are no historical returns, maybe because this investment is new, for example, they don't have historical information. So how to measure the risk? Okay, we can still measure based on some assumptions. Okay, we have to assume, right? So the assumption must be based on several information ataupun several conditions. So usually what we do, we will assume based on economic conditions. Okay, economic condition, estimates based on our assumption. Okay, so here are the measurements. Still measurements sama We have the ER, expected return. Kalau tadi kita just take the average. Here we have to use the probability based on the economic situation. And then we measure the variance. Okay, in fact, the formula is still the same. Cuma beza dia, we have to use the probability. Standard deviation is still the same, square root of variance. And coefficient of variation also the same formula. Okay, the only part will be different is the first two. Okay, now this is another example with no historical returns. Okay, but we need to project. Okay, using these 3 economic conditions punya assumptions. And on top of the 3 different economic conditions, we have 3 probabilities of how good the chances of each economic conditions will happen in the future. So here, as you can see, out of these 3, okay, the highest chance would be the average condition. So meaning our economy next year, for example, assumption will be on average, not high or not in the good condition or not bad. All right, it will be average. Okay, so 60% chance it will happen that way. Right, and then another 25% will be in good condition, and 15% we will see recession, for example, next year. So when you add all 3 conditions, okay, the probability should give you 100% chance. Okay, the combination ataupun the total probability must be equivalent to 100%. Right, and for each economic condition, they will give us different returns. Okay, if it's in the good economic condition, it will give you the highest 28%, the average 15%, and if it's in bad economic situation, we just will receive 1% return. Right? So the question asks us to find the variance, standard deviation, and coefficient of variation. We know that in order to find standard deviation, we need to have our variance. And to find variance, we need to have what we call the expected returns. We need to have the average return. Okay, that's estimated ataupun the expected. Okay, based on the probability. So to find the expected return, if I put it ER kat sini, ataupun I should put it down here. Okay. Simply multiply the probability with the estimated return, and then you sum all three. Okay, you sum all three. So meaning you take 25% times 28, so it will be 7%. 0.6 times 15 is 9%. 15% times 1 is 0.15%. And when you add all three, so you give us 16.15%. 16.15%. So this is the average return. Okay, you don't have to divide by 3, because we are not taking 28 plus 15 plus 1 divided by 3. No, we cannot do this. Okay, this is based on just 1 year's punya performance. Kalau kita bahagi tadi average tadi, that was based on multiple years punya returns. Okay, here we assume for the following year, just for 1 year, but from 3 different scenarios. Okay, so we cannot take all 3 and then divide by 3. It will not work that way. We have to multiply each one with the probability. Okay, so maknanya I multiply these two, then you get this, and then you sum all 3 to get the expected return. Okay, so this is your expected return. So, sorry. So this one, number 1, is 16.15%. Okay, and once we have this information, then we can find the variance. So kalau variance, again, similar like our earlier example, is to take the difference. Okay, if I put a bracket here for variance, is 28% minus 16.15, the average, squared. Okay, so for every level, you need to take the estimated return, 15, for example, for average, minus with the average, 16.15 squared. And also the last one, 1% minus 16.15 squared. Okay, and then we need to sum all 3 lah. Okay, based on this, the difference times the probability, and then you sum. So meaning, if I put the variance calculation here, okay, if I put 0.25 times 28 minus 16.15 squared plus 0.6, 15 minus 16.15 squared, and then add the last one, 0.15, 1 minus 16.15 squares. Then you get the variance. Okay, can someone help me dapat berapa ni? What is the variance based on this calculation? So this one you will get 35.5. 1056. The second one, 10 minus 0.15. Here is 0.7935. And the third one, minus 34.4284. So when you add all three, so you get 70.33. Okay, 70.33. So this is your variance. Okay, and if you square root 8.38. Okay, so standard deviation would be square root of 70.33. So you get 8.37. Okay, good. Thank you, Ida. 70.3275. Yeah. Better to have four decimals actually. 70.3275. So if we square root that, okay, dia punya answer is slightly more, 8.39. So then 8.39. Okay, and to find coefficient variation, CV is 8.39 divided by 16.15. 0.52. Okay, so that's how we measure the risk and also return for the projection returns. Earlier, number one tadi, we measure using historical returns, meaning we have multiple years of information, then we measure the variance and also the standard deviation. But here, usually for new investment ataupun investment that don't provide us the historical returns, we can estimate. Okay, any questions so far? So basically, this is the first half of our measurement when we do quantitative analysis based on historical and also estimations. We can measure the annual returns. Number one, if you recall, we have number one, measure the annual returns. So once we have the annual returns, if we have a set of it, we can use the average. So we have arithmetic means and also geometric means. And on top of that, if we take into consideration the risk, okay, we can add on the measurement of variance and standard deviation and also coefficient of variation or CV. And these three, variance, standard deviation, coefficient of variation, we can measure according to two sets of information. Either we have a full set, if we have full information about historical returns, we can use the average returns, okay? And we measure all three. And if you don't have, we have to project or we have to estimate. Okay, we have to estimate based on the projection returns. Then we will get the same information, variance, standard deviation, and also coefficient variation. So simply, the higher the score for variance, standard deviation, coefficient variation, the higher the risk. Okay, the higher the risk. So if you have two investments, and if you want to compare between the two, obviously the higher the all of this information, the higher will be the risk for that particular investment. So again, if there's no question for the first part of our lecture today, let's take a quick break before we measures the yardsticks for selection of investment. Okay, so this is basically similar like capital budgeting, as I mentioned earlier, whereby we're going to use simple measurements, simple modeling, ataupun simple techniques that we can use in order to decide later on in a form of payback period, net present value, and also internal rate of return. So the most sophisticated modeling ataupun techniques that we're going to use, it's better to have these two, to have financial calculators. So I will use financial calculators later on, how to calculate net present value. So again, if you don't have financial calculators just yet, I suggest you to get one is as soon as possible, ASAP, because it will help you to calculate relevant information, especially with regards to investment. And again, as I mentioned during our first meeting, it will be beneficial for you, but you will use this in a lot of courses, especially later on in module 7. Okay, so let's take 5, okay, before we move on with this yardstick for selection. Okay, let's move on to the second part of the lecture for today's topic, the quantitative analysis ataupun the quantitative techniques for decision making, selection of investment. So, as I mentioned before our break just now, here are some any brand ke casio je? Tak semestinya. You can use any brand actually, as long as dia can work. Cuma when I do some illustration ataupun some example, because I have casio kan, so I will use casio lah obviously as reference. So, and other brands I tak familiar with sebenarnya in terms of how to use and how to key in the information contohnya. So kalau macam casio ni, kalau nak calculate net present value ataupun IRR, we have that function kat dalam ni. So, but it will not be a mandatory thing. Okay, you kena beli casio tak? I will not letak that as syarat lah. I put it, I let you decide which one is the best for you. Okay, maknanya kalau other brands, you have to learn on your own. You have to search the information macam mana nak guna and whatnot lah. Okay, but in our lecture ataupun in our class, what I can do, I just can share using the Casio punya method lah, because that's the only calculator that I have for financial calculator. Okay, thank you for asking. All right. So when we want to do selection ataupun decisions, let's say you have two different investments, okay, for two different projects, for example, and we have estimated 5 years returns for these two projects. Okay, year 0 here indicates the cost, okay, the cost of investment. Both will cost equivalent 250,000, and with two different sets of returns. Okay, for project B, the total return is 360,000. For project A is 315,000. Okay, so with the different returns every year, even though both, especially project A lah, project A, as you can see, the returns are declining every year from 100,000, the highest, 80,000, 70, 40, and 25,000 in year 5. So they decline every year. As for project B, they fluctuate a bit. Okay, from 105, drop to 85, drop to 40, and then go up to 60, and go even higher, 70 in year 5. Okay, so we have two different sets of cash flows. Okay, so for this example, it's quite easy to guess which one should we invest in. Okay, however, mathematically, or using the techniques, I will show you the differences of results based on the three measurements just now. Okay, remember we have PP, payback period, we have net present value, and also internal rate of return. Okay, so for PP, we can calculate manually using our normal calculators. However, for NPV and IRR, especially IRR, it's easier if you use financial calculators. Okay, for NPV, I still can teach you how to calculate using manual calculations. Okay, but it will be tedious sikit lah. Okay, but anyway, I'm going to use this example throughout all three measurements. Okay, so the first one is payback period. You baca lah ni payback period dia punya steps. The one that I want you to focus is actually to calculate the payback period itself. So we need to measure, okay, the cash flow up until the initial investment is recovered. Okay, that's our first step, to find the cash inflow accumulated until the investment is fully recovered. Meaning, okay, bear with me, I have to go back and forth. We know the cost of both projects are 250,000. Okay, so let's focus on project A first. Okay, so for project A, okay, in order to generate ataupun to accumulate up to 250,000, it will take 1 year, obviously, 2 years. When you add these two, baru 180. And when you accumulate in year 3, these 3 years, and when you combine these 3 years, it will give you a total of 250K. Okay, 250K. So if you get this exactly as the cost, when you add all three cash flows, and it will give you the exact amount of the cost, we can see that project A, the payback period is 3 years without having to do any calculation. Okay, so payback period for project A is basically 3 years. How I know 3 years? Because when you add all three, that indicates that we already recovered the cost. Okay, payback period is basically the period ataupun the time that we need in order to generate back our costs, to cover back the costs, right? Balik modal in Malay. How long it takes for you to break even. Right, so in this case, project A requires exactly 3 years. Okay, so we don't have to calculate, we just add one by one lah. Okay, if we get exactly the same as the cost, we don't have to do anything else. We know the payback period is 3 years. Now we look at project B. Okay, it's the same cost of 250. So year 1 is 105. Year 2, when you add 190,000, still does not recover 250. 190 plus year 3, another 40,000, 230,000. 190 plus 40, 230, still not recover the 250,000. So we need to add the 4th year. If we add 4th year, all of this will give us 290,000. Okay. So is it the same as our cost, 250? No, we generated more than 250. So therefore, we know it will be within 4 years' time, but exactly how long it takes. We cannot say it's 4 years because 4 years kita generate 290,000. We want to know at what points we get this 250,000. So in order to get the definite or the exact time, then we have to use this formula. Okay, so here represent which year we recover fully the initial investment. So in our calculation just now, we know we generated enough money, enough inflows in year number 4, even though it's more, kan? So our year in the formula are representing year number 4. Okay, because year number 4 indicates we recovered the cost. Okay, so therefore, if we put the formula ataupun the answer, let's say like letak payback period for project B, year is year 4 minus 1. Okay, it's always minus 1. And then we add with IO. IO here referring to initial outlay. Okay, IO equals to initial outlay, or simply mean the cost. Okay, the cost of your investment. So the cost just now is 250,000. Okay, 250,000. So even though they put it here negative ataupun in bracket, but it doesn't mean it's a negative investment. This is just to indicate that it is outflows. As investment, you need to fork out 250,000 ringgit. So that's the cost for you. So you put 250,000 here without the bracket, and we minus with, okay, accumulated cash flow before year. So our year just now defined as year 4, kan? So meaning it's accumulated cash flow before year number 4. Okay, based on the 4 years punya accumulation, we have 290, kan? But if we just take accumulation before year 4, meaning just for the first 3 years. Okay, I calculated just now, it was 230,000. These all three, when you combine, okay, the accumulation would be 230,000. So that would be our accumulation lah. Cash flow before year 4 is 230,000. Right? And when you minus this, the difference is always a positive value. So it shouldn't be more. It shouldn't be more than 250. You shouldn't get negative result yang dekat numerator ni. It's always be positive result. So maknanya 250 minus 230. Sebab kita punya accumulation mesti before the IO fully recovered. Okay, and cash flow for the year, meaning cash flow for year number 4 is this one. Okay, or the difference between the two lah, which is 60,000. So divide by 60,000. Then solve the equation. Plus 3. So we have 3.33 years. Okay, 3.33 years. So this is how long it takes in order for project B to be fully recovered within 3.33 years. Okay, so here kalau letak summary dia, payback period for project B would be 3.33 years. Okay, so if we just based on payback period alone, okay, if we just based on payback period, if we compare project A dengan project B, which one is better? Obviously, the faster you recover, the better your decision, kan? Maknanya, the faster you get your money back. So based on these two, alright, and if you use ataupun if you rely just on payback period, you're gonna choose project A lah, project A, because project A generated faster returns. Okay, we're gonna choose project A because we can generate the return faster. But will it be a good decision if we just rely on payback period? So the answer is no. Okay, the answer is no, because if you read the advantages and disadvantages, you can see lah. Because even though the advantages, macam contohnya, it's easy to compute and to understand, but very simple. Okay, nak calculate tadi pun senang je, and to explain pun very easy because the number of years you get simply means that that's how long it takes for you to recover the cost. Okay, but obviously there are some drawbacks. Okay, and the major one is the negligence of the amount of cash flow after. They don't care after the payback period, especially this part. Tengok for example, for project B, the returns is even higher towards the end after they recover the cost. Unlike these two, the return is quite lower as compared to project B. So they totally ignore this information because we just want to know how fast and focus on the earlier parts of our returns only. Okay. And the second part would be they don't use the concept of time value of money. Okay, time value of money, because when we have this information based on futures information and using the time value of money concepts, okay, that I think you've learned this in financial management before, and time value of money concepts. The 1 ringgit today that you have is not the same as the value of ringgit in the future, because the money that you have now you can invest. Okay, so macam contohnya lah, the 100,000 ni, if you bring to year 5, it obviously will be more. Alright, so therefore, by not having time value of money in our calculation, obviously you ignore lah, the chances of ataupun the actual ringgit that you should get in the calculations. Okay, so period dia just totally ignore. It still can be used as our indications. However, if you rely just based on payback period, it will not be a good decision. So what would be the best, okay, to incorporate more analysis? So that's why we have another two. We have net present value, and also we have internal rate of return. So for net present value, okay, the formula, okay, is to have the present value of the future cash flows, and we minus with the initial outlay, the cost just now. So meaning all of our cash flows, okay, bear with me, all of these cash flows from year 1 until year 5, you have to bring it to today's value. So all of these years, year 1, year 2, year 3, year 4, year 5, you need to bring it to year 0. So how to do it? You have to present value all of this. Okay, you have to present value all of this, and then minus the cost and see whether the answer will be in positive values. Okay. Okay, so in order to use net present value, you need to assume the discount rates. Okay, so dalam case ni, dia kata discount rate dia 10%. Okay, so based on this discount rate of 10%, calculate the net present value based on example number 4. Okay, so we have the discount rate of 10%. Okay, kalau you ingat present value, in order to find the present value, okay, using manual calculations, it would be present value equals to cash flow multiply with present value interest factor, okay, K and N. Okay, this is the formula, manual formula, in order to get the present value of 1 year, 1 year. So maknanya cash flow ni is for cash flow, for example, year number 1, present value of interest factor. K is the discount rate, 10% for example. N tu, kalau first year, N equivalent to 1. Right? So meaning you have to calculate all the present value for 5 years. All 5 years, you have to present value kan satu-satu. Okay, but if you have financial calculators, okay, for example, I will explain using Casio ni, Casio FC100, or if you have FC200, you can use it. And there's one function, okay, one function which is labeled as cash. Okay, kat sini ada cash. Okay, you use the cash flow punya function. And the first thing you will see is I%. I% is the interest rate. And remember our assumption, the K ataupun the discount rate is 10%. This is the assumption. So you're going to put 10% in I dalam satu apa? The first line ni is I%. You put 10% and then you press execute. Secondly, there's a cash equivalent to D editor. So this is where you insert all of this information. So I'm going to insert project A first. So for cash editing, I'm going to press execute. In Excel, macam partial Excel kat sini. With on the left column ada numbers 1, 2, 3, 4, 5 sampai whatever number of years you have. And then X. And the X section ni yang kita nak insert all of this information from the question. So, dia tak start dengan 0. In our financial calculator, it starts with number 1, year number 1, ataupun period 1. So, for period 1, we substitute dengan year 0's information. And since this is negative, ataupun bracket tadi, please put a negative information. So, you put, for example, in period 1, minus 250,000. And this minus, like I said, indicates outflows. Duit keluar. And next, you put 100,000. Next year, letak 80,000. And then 70,000. Then 40,000, year number 4. And number 5, 25,000. Okay, and then you press escape. Dia ada button escape kat sini. You press escape. Then you dah insert the cash flow punya information. So in order to find the net present value, just below that, dia ada tulis kat situ NPV soft. Okay, dalam financial calculator tu, you will see NPV and then soft. Okay, so you go to that function, and then again in your calculator, dia ada button soft dekat sini. So simply press the soft button. You have to wait for a while, and automatically they give the MPV for project A, RM 2,460 ringgit. And dia ada 40 cents kat ujung. Okay, 2,460 ringgit and 40 cents. Okay, that's how we measures net present value. Right. So that's net present value. I skip project B for a while. Sekejap je. I skip project B because kenapa? Sebab I dah insert all the information. Okay, I already inserted all the information dalam financial calculators. And if you go back to the cash flow function, tadi I mentioned we have bear with me, the NPV soft. Okay, the NPV soft. Under the NPV soft, okay, there's another function. is called IRR solve. This is the internal rate of return. Okay, so meaning by not looking at this information, we can calculate the internal rate of return because we already, inserted our information. So in this case, I'm gonna go straight away. Okay, choose the IRR solve based on the information I already insert earlier. And when I push the solve button, okay, they take a while to calculate. Okay, I get the IRR, internal rate of return, for project A, which equates to 10.48%. Okay, 10.48%. So this is our internal rate of return for project A. So what does it mean? So by looking at the time value of money concept, based on the discount rate of 10%, okay, so discount rate ni sebenarnya apa before I move forward this is the assumption, okay, assumption of returns that you ataupun let's say if you need to borrow money, for example, this is the cost. Okay, this is your cost of capital. Okay, and when you have this cost of capital of 10%, the assumption that we have for internal rate of return for project A, it generated 10.48%. So we can see the rate of return ataupun the internal rate of return is higher than the discount rate. So this indicates that this project A is a profitable investment because we generated more than the cost. Cost of capital is 10%. And the return of our investment based on IRR is 10.48%. So we have a slight profit margin kat sini. Just about 0.48%, not even 1% sebenarnya. Okay, but still it is a profitable investment. Okay, it is a profitable investment. Right. But how macam mana nak kira kalau guna manual? Okay, if you don't have financial calculator yet, that's why I said you have to have this ASAP. But if you don't have it, you can calculate manually, but it will be tedious. Macam I cakap tadi, it will be tedious. How tedious it will be? So there are two possibilities how to use manual calculation. Number one, everything is manual. Everything is manual. Okay. Sekejap, so the one yang tedious is actually the ones in the bracket. Okay, the one in the bracket. Because the one in the bracket is actually the interest factor, the one that we want to find, the interest factor of our interest lah. So meaning, in order to get the results of answers in the one in the bracket, there are two ways. Number one, you use manual formulas, or number two, you can refer to a table. Okay, present value tables. Okay, bear with me kejap I guess you pernah tengok table ni before. Okay, so this is the table. Okay, the table that we can use to calculate our present value just now. Okay, so present value table dia yang this one. Okay, present value. Okay, this one present value. Okay, PVIF I wrote just now, PVIF KN. So if you don't have this table, you kena guna formula ni. 1 divided by 1 plus K to the power of N. Okay, or else you can refer to this. Kita punya discount rate just now is 10%. So our concern is just this, 10%. 10% punya function lah. So this 10%. It's 10%. Okay. So we have this interest factor. So we have 0.9091, 0.8264. So how to get this information? By using this formula lah, basically. So maknanya kalau 10%, so 1 divided by 1 plus 10% to the power of 1, you will get 0.9091. And then 1 divided by 1 plus 10% to the power of 2, you will get 0.8417. Okay, but if you have this table, you don't have to calculate lah. So now, the tedious part of calculating MPV, if you don't have financial calculators, because this is a formula, right? Let's see, bear with me. Keep it up for time being. Let's see, I add a blank slide ni so that I can calculate for MPV. I letak kat sini. MPV B, project B. Okay. So the formula for MPV is this one. Present value minus initial cash outlay. So what we need to do is to have this present value using this formula, and then we minus the IO. So this is the table, right? So basically what I'll do usually, kalau guna manually kita ada year 3, year 4, and year 5. So year 1, 105. I have to rewrite balik dulu 85, 40. 60, 70. Right. So this is your cash flows. We want to find the present value. So we need to have this present value interest factor. So we know the discount rate. The K is 10%. Okay, 10%. So by looking at the table earlier, this table, actually, this one. So it will be, I minimize this. So I cannot write kat sini. I have to go back and forth nampaknya. Ataupun 0.9091. .8264. I use calculator je nak kira ni. 1 divided by, in the bracket, 1.1 to the power of 3, 0.75. 1 divided by 1.1. Power of 4. 0.6830. And lastly, 1 divided by 1 to the power of 5. 0.6209. Okay, so this is all the present value interest factor based on the table just now, or else you can use calculator tadi. Kalau nak calculate satu-satu, is basically 1 divided by 1 plus K to the power of N. Okay, N ni maknanya kalau for year 1, is 1 divided by 1 plus 10% to the power of 1. So you dapat ni. For second year, 1 divided by 1 plus 10% to the power of 2, then you get this one, and so on. So to get the present value of cash flow, simply multiply each and every single of the cash flow for the relevant years. So meaning 5 times 0.9091. So you get 9,550 cents. So 85,000 times 0.8264, 70244. Year 3, 40,000 times 0.7513. So you get 30,052. 60,000 times 0.6830. It's 40,980. And finally, 70,000 times 0.6209. So it's 43,463. So add all 5. So you have here 280,194 and 50 cents. So this is your present value of cash flows total. Total. This is the total. 280,194 and 50 cents. So your initial outlay is negative ataupun minus 250,000. This is the cost just now. So you minus 250. So you get net present value of 30,194.50 cents. So this is your NPV. If you don't have financial calculators, imagine this is the steps you need to find in order to get net present value. Okay, well, I double check with the financial calculators. For the cost 250 and 105, 85, 40,000, 60,000, 70,000. Dapat apa tadi? So ada slight difference sikit lah based on calculator. Based on calculator, the NPV for project B would be 30,200 ringgit and 37 cents. Okay, ada slight different because of the decimals that we use. But this is just based on 4 decimals. Our financial calculators based on the whole decimals that they have. Okay, so obviously there will be some differences lah. Okay. So to calculate IRR. Okay, untuk calculator, very simple. You just escape, go back to the cash flow punya function. Just below the NPV solve, we have the IRR solve. Click the solve button. Okay, take a while kejap, tak kira. Okay, so the IRR for project B is equivalent to 15.19%. Okay, 15.19%. And comparatively, if you take a look of this dengan yang ni, okay, obviously project B has higher MPV, 30,000, and higher internal rate of return at 15%. This is just 10% kan, 10.48, 10.5. For project B is 15%. So comparatively, kalau based on payback period, project A is better because we generate the returns faster. However, based on the value itself, based on NPV and internal rate of return. Project B is actually give us better returns because it gives us higher net present value. We get more money into this value. And secondly, the rate of return is higher. Okay, imagine the cost is 10%, you can get 15% returns. Okay, so that's the assumption. Okay, so we can use manual calculation to get net present value. Okay, this is for project B, yeah. But how to calculate internal rate of return for, sorry, internal rate of return using manually? Okay, it will be even troublesome nak kira. Okay, because when we want to calculate internal rate of return manually, we need to assume. And once you assume, we need to do interpolation. Okay, using this interpolation. Right. Just to illustrate. So if we have NPV at 10%, it's 30,000. It's 30,194. Because when we want to do IRR, internal rate of return, we need two sets of data. Okay, two sets of data. In order for us to calculate, because we want to know at what point, at what rate, because when we calculate internal rate of return, kita nak cari IRR ni. Okay, in our NPV, this part we use K, the discount rates. But here, we're gonna put this as the unknown information because this is what what we want to find. Okay, so we want to know at what point ataupun at what rates when we have the total cash flows of the present value and the initial outlay to be at the same value. Okay, at the same value, which equates to 0. So meaning when we minus these two, we get 0. So in order to minus these two to get 0, meaning this present value must be exactly the same as initial outlay. So we know in our example just now, the initial outlay was 250,000. So if we use 10%, kita calculate guna 10% tadi kan, if you use 10%, our present value interest factor is, sorry, not present value interest factor, the total present value is 280,000. Okay, bila kita letak the K at 10%, we get 280,000. So we want to know at what rate will be the total equivalent to exactly 250,000 so that we get 0. All right, so that's why we need another rate lah basically in order to get closer to 250,000. Okay, actually when we want to calculate manually, kita kena buat trial and error. We need to calculate. So tadi kita dah calculate 10%. So next kita kena calculate lagi 12%, 14%, 60%, whatever. But since we have actually the answer, let's say we calculate based on 16%. Okay, you have to bear with me lah sebab nak calculate manually memang it will be troublesome. So I'm gonna use another slide as ni to calculate internal rate of return for project B. Okay, so what you need to do, you have to calculate NPV, another NPV. Okay, you need to calculate another NPV. So let's say NPV B at 16%. I letak 16%. Kalau tadi K is 10%, right? So we are using 16% now. Okay, you have to calculate all of this. You can repeat balik the same process. Y1, Y2, Y3, Y4, Y5. 5, 85, 40, there, 40, 60, 70, 40, 60, 70,000. Okay, so this is the cash flow. Now you need to find the PVIF. And we are using 16%. Okay, 16%. So again, you need to calculate 1.16 now. Now the B8620, 8621, sorry. And then 1 divided by 1.16 to the power of 2, 0.7432. And 1 divided by 0.16 to the power of 3, 0.6407. 1 divided by 1.16 to the power of 4. It's 0.5523. And 1.6 to the power of 5. 0.4761. So present value of cash flow multiply at the 63,172, 40,000 times 0.6407, 25,628, 60,000 times 0.5523, it's 33,138. And lastly, 0.4761. It's 3. So you add all 5. So 245, 785.5. Okay, so this is the answer that we want. So ni total ya. So IO tolak ataupun negative 250, sorry, 250. So your MPV dalam case ni negative 4214.5. Okay, now to calculate the internal rate of return. Now we have two sets. This is based at 10%. Kita dah calculate tadi. We have positive MPV. Now we have negative MPV. Okay, bear with me. Yeah. This is where we want the MPV to be 0 so that the value is the same. Okay, the value to be 0. Okay, ataupun the value of IO dengan total cash flow to be the same value. Sorry. So in order to get the actual return ataupun the actual IRR, we need to have this information. Lower rate plus the difference of the rate, higher versus minus or worse, times dengan the value. Okay, but anyway, what I'll do usually, okay, in order to find the internal rate of return, we have two rates. We have kita ambil yang high dulu Kita letak rendah dulu 10% IRR 16%. Okay, this is the one that kita nak cari the rate based on the 10% IRR and 16%. Okay, based on 10%, okay, based on 10%, kita akan gunakan total cash flow je. Is 280,194.5. And then for IRR, it will be 250,000. Okay, based on IRR, equivalent to 250,000. And for the 16%, the total is 245. I round out je lah, 786. Okay, so based on this, we have to find differences between the lower value minus IRR, lower value minus higher value. So meaning, you need to find, this is LR, this is IRR, this is higher value lah. So meaning you need to find the difference between these two and the difference between the top and the bottom. So meaning 280, 194 minus 250 is 30,194 tadi. And the bottom part will be 280, 194 minus 245,786. So it's 34,408. Okay, so you have two differences here. What you need to do, okay, so the IRR would be 10% plus the difference 30,194 divided by 34,408 and multiply with the difference of 16 minus 10%. So the difference of higher dengan lower, 16 minus 10. So that's why cuma I letak dia terbalik So this is basically sepatutnya ada bracket kat sini. So this is the difference minus divide by and then multiply with the difference of 16 minus 10 just now. So it's 30,194 divided by 34,408 times 6%. Difference time 16 minus 10 is 6% kan? So times 6%, you get 5.27%. So when you combine, it will be 15.27%. So this is your IRR, 15.27%. Okay, ada slightly different from the calculator. Calculator 15.19, but based on manual calculations, it's 15.27%. So which one you prefer? Obviously, you use calculator, financial calculator is much faster. Okay, and again, how I choose 16% ni tadi is based on because I already know the answer is 15.19, so I just choose 1% higher, which is 16%. Imagine if you don't have that answer, you need to calculate the MPV ni, the process to find negative MPV. So you need to calculate one by one. Initially we have 10%, you get 30,000. So then you assume, okay, I naikkan the rate. In order to reduce the number, you have to increase the rate, because the higher the interest rate, the lower your MPV. Okay. So imagine you calculate 12%. After 10, you calculate 12%, for example. So 12%, bila you calculate 12%, imagine 12%, you still get positive MPV. Okay. You cannot stop there. You kena cari ataupun you have to stop when you have an NPV negative ataupun negative NPVs. So at 12%, you still will get positive. Then you try 14, and then whatever lah, sampailah you dapat negative. So in this case, 16% you get negative. Once you have this negative, then baru you boleh buat this, what we call as interpolation tadi. Interpolation. Okay, the process of interpolation. Yang ni. Right. So selagi tak dapat, why we need negative at the first place? Remember, because our IRR, the value is equivalent to the difference is must be zero kan tadi. The IRR, sorry, when IRR apa? In order to find IRR, we want to know at what rate the MPV to be zero. So to be zero, the cash flow and also the total cash flow and also the IO must be the same. And we know the IO is 250,000. So that's why I put the 250 is in the middle. Right, in the middle. So we need to find the two NPVs ataupun the two, not MPV, two total present value cash flow. One is higher, one lower. So you cannot find some, kalau you letak 12% kat sini, memang 10 IRR, 12% IRR ni betul in between, tapi our value nanti will not be in the middle. Okay, the 250 ni nanti kalau you letak 12%, it's still higher than 250. So you akan letak 280,194, 250, and then for 12%, it will be, I don't know, 270 contohnya. So it's not fit the information. The information, the IRR must be in the middle. Okay, the 250 must be in the middle. You want to find the rate that give us lower than 250, which is equivalent to negative MPV. So that's why we stop at 16%. So once we have this, baru interpolate, then we get the information ataupun the IRR. So my suggestion, invest some money and get the financial calculators so that you can save time and save the hassle of calculations to get the internal rate of return, which is very fast. Okay, using calculators as compared to using this manual calculation. Tu tak terkira kalau you salah, you add wrongly, for example, you miss one button to enter and then get the wrong answers and whatnot. Right, so as a conclusion, as a summary, based on the three approaches, our payback period suggests project A better because, as I said, it's faster. 3 years versus 3.33 years. Okay, so project A is faster. It's a tiny bit faster as compared to project B. Okay, so it's easy to calculate. However, it is not wise, okay, just to use payback period alone. Okay, because they like I said, they disregard the time value of money aspect of it. So therefore, we use MPV and IRR. And based on these two techniques just now, obviously we saw that project B is better because it's higher MPV and higher internal rate of return. Okay, so if you ask me which one to use to justify our usage, obviously kita akan always use MPV and also internal rate of return for our justification. Okay, so most finance managers and investment analysts will use ataupun will prefer MPV and internal rate of return as a yardstick ataupun as a benchmark for selection for investment proposal. So that's why the financial calculator is very, very important, because by having, bayang kalau kita nak tukar the return ataupun the K just now, the dividend, the discount rate from 10% to 12, 14, or you want to lower it down, just change one button je, you get the NPV straight away. Okay, but imagine if you don't have, you have to suffer with this method of calculations. You kena calculate ni, tukar to 8%, you have to do a set of calculations. Okay, imagine sebab masa exams, you don't have computer. Kalau computer, you can use Excel, for example. But during the exam, you need to use pen and papers. So the obvious tool to use is your financial calculator. Okay, so with that, I end the topic number 2. So a lot of calculation for this topic. Okay, so what I'll do, I will post some questions for you guys to answer for topic number 2 ni. Okay, as a quiz nanti as a quiz. So I will post the question dalam my group. Dalam my guru. So please check, and I will give you ample time. I know because we are near the Raya, kan? So I will give you ample time to answer quiz number 2. So just check my guru later on for our very first quiz for topic number 2. All right, so any question? All right, so if there's no questions, thank you very much. For next week, I know it's towards the end near of Ramadan and near to Hari Raya already. So I still not decided whether we're gonna have a class ataupun tak. It depends on my mood nanti on that day, on that week. Sebab technically I'm still working until Thursday because we are unsure whether Raya will be on Friday or Saturday, right? But anyway, I will still be working on Thursday. Let's see lah. I will let you know next week whether we're gonna have a class. Obviously, kalau ada class pun will be online because week number 5, everybody agreed. It's instruction from the academic office to have an online session as well for week number 5. So if we do have class next week, again, we're gonna do it via Webex juga lah. So for that, thank you very much, and please aware of the quiz number 1 in my guru. So just check every now and then. So thank you very much, and I'll see you next time. Thank you.
Thank you, Doctor.
Thank you, Doctor.
Okay, welcome.
Thank you, Doctor.
Welcome.